Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm privileged to welcome a very senior and accomplished professional from San Francisco, USA, Mr. Ajay Chopra. Ajay, welcome to the show.
Glad to be here, Ashutosh.
Ajay is the general partner of Trinity Ventures, which is focused on early stage investments in consumer and business applications and services. So Ajay, before we talk about Trinity, tell me a little bit about your own journey in brief.
Yeah, so I was actually born in New Delhi, where you are. And I grew up all over North India. My father was in the Indian Railways, so he would get transferred every 3 or 4 years. From Delhi, we went to various places in UP and then to Rajasthan. I did my undergraduate at BITS Pilani, so I'm a Pilani grad.
Yeah.
After that, came to the US to University of New York at Stony Brook on Long Island. Did my master's in computer science and electrical engineering there. Worked in Connecticut for a little while, then worked with Atari, which was a games company. I'm sure you remember it, but most of the young people probably don't remember Atari. And then from Atari, my boss kind of took me to a startup. That startup raised a lot of money, but it actually failed. But I had the front seat to witnessing the entire journey and got the startup bug. So along with 2 other folks, spun off to do a company called Pinnacle Systems. And the vision was to kind of do for video what Adobe did for pictures.
Wow.
So we built over a period of 15 years, we built a $400 million business, took it public on NASDAQ, had multi-billion-dollar market cap. And then in 2005, I merged that with another public company called Avid Technologies, which actually edits almost all movies and, in India and everywhere, almost all movies I cut actually edited there. And then after that, I started investing my own money in startups, as most entrepreneurs in Silicon Valley do, as you know. And then sort of one thing led to another. I was asked to kind of help out with a couple of deals at Trinity Ventures. And when they raised their next fund, they asked me to join full time. So that was 16 years ago now. And for the last 8 years, I'm actually the managing partner of the fund. So that's my quick journey, my journey in quick 1 minute or 2.
Absolutely. And as they say, the rest is history. So wonderful. So let's talk about Trinity Ventures, Ajay. How did you get started in the world of private equity after being an entrepreneur and investing your own money, and particularly focusing on early stage investments?
Yeah, so it was kind of like what we were talking about early about sort of giving back. As you go through the entrepreneurial journey, you face a lot of joys and lots of tribulations. So, I felt that I could actually help the early stage entrepreneurs as they're seeking to just get the companies off the ground. I had obviously developed deep operating experience at every stage of the company's growth, all the way through the IPO and beyond. So I felt that it would keep me engaged, and working closely with entrepreneurs. So that's what I was doing myself when I was investing my own personal money. And Trinity has that exact thinking, right? So they want to be long-term partners, come in early, get on the boards of these companies, and actually be, partners in building the team, building the financial base of the company, helping them strategically with markets and market pivots. By the way, that happens inevitably with startup companies over time, and kind of be along that journey, till they go public and sometimes even beyond. So I've been on boards of companies for 12, 13 years, post IPO and so forth, when we were the very first money in those companies. So Trinity's vision was very similar to what I wanted to do. And the partnership had been around at that point in time for over 20 years. And now it's been over 30 years. So long-standing reputation in Silicon Valley, lots of, great history. They were, by the way, the first investors in Starbucks, and Jamba Juice and PF Chang's and all these, consumer brands way back when. Obviously, I was not there with them at that time. So, and they continued that, investment in consumer businesses as they went online. So companies like Fitbit, where we were investors, and then also, in SaaS businesses as they emerged. So software as service, And now, obviously, a lot of stuff that we're doing is related to AI or generative AI and so forth. So, yeah.
Fascinating, fascinating. But Ajay, the other question that I had is that given the high risk of early stage investments, what metrics do you look for before making an investment?
Well, actually, in early stage investments, there really are no metrics because most of these companies have very little to no revenue. So the first thing we look for is the quality of founders. Like, are they really dedicated to this idea? And then the two very important questions that we think through, and we actually ask them, is why is this idea that they've come up with, right for this time? Okay, so for example, a very simple example is, Ola cabs or Uber would not have been possible before mobile devices became,
right,
everywhere, right? Everybody was using mobile devices. Those things were basically mobile was enabling technology for those types of services. So the question we ask is why now? Okay, and that has to be a decent answer to that. And then the next question is why you? What makes you so special?
Yep.
That this opportunity that is emerging is something that you can grasp, and make a large company rather than somebody else that may be thinking about also recognizing that market opportunity, right? Yeah. And then I would say the last thing is it's the compatibility of founders, right? Typically, the companies are started by 2 founders, sometimes 3, sometimes more. And what we have observed in a long history of investing is founder incompatibility actually becomes a big problem and is a very large reason for companies failing.
Right.
So we want to make sure that they have had maybe they've worked together for a while, maybe they went to college together, they have compatible skills, so they won't be stepping on each other's toes, things of that type. So these are qualitative things we look for rather than metrics, at early stage. Yeah.
And given the amount of experience you have, first with your own money and now with Trinity, for my viewers and listeners, tell me what are some of the basic mistakes a lot of startup entrepreneurs make?
So, the typical thing that startup entrepreneurs in the tech world do is because they're technology people, they sometimes think that if they build, the customers will come, right? So, but the fact of the matter is that even the best products in the world have to be sold, right? Even iPhone had to be sold, right? I mean, the marketing campaigns and so forth. So this is what I meant by having a founding team that is compatible. So I think usually we would prefer someone that's got sort of an outbound go-to-market skill set combined with a deeply technical founder. That's actually the formula for success is pretty good there, right? So that type of thing is one typical, things that technical founders in particular might overlook. The other thing is that founders are very, very impatient. They sometimes work on an idea, and if they don't see immediate market success, they want to pivot. But markets move at market space. Technology can move much faster than markets move, right? So I think recognizing that and being patient, keeping the burn rate low, and then making sure that the market is coming to them as they are progressing with their product development and product introduction to the market is very, very important. And the last thing we would tell them is, there's only one reason why companies fail, right? I mean, you can be a terrible CEO or horrible founder, you'll still be fine. And that reason is if you run out of cash, right? So if you don't have cash, you're out of business, right? So keeping an eye and having that mindset to be frugal in early stages, particularly in early stages, while you're still experimenting with your idea, getting the initial customers, developing the thought process and how to go to market. It's really important to conserve capital, right? So we are there with them, because we've been through this journey ourselves, side by side, giving them guidance. I mean, of course, this is their company, so we don't want to be, acting CEOs of any kind. Yeah. But we are very involved board members and partners. Yeah.
Very interesting. Great response. Thank you. And how involved do you get post-investment other than a board position? Is it just financial support, or do you also get involved in strategic guidance and governance?
Yeah, actually, financial support is the least of all the reasons because, everybody's money is equally green. So, people get money, particularly now compared to 10 years ago, from lots of different places. people come to Trinity and, to me personally, because of my own entrepreneurial journey, right? So, and they know that I can, have late night conversation with them when they're going through some very difficult issue. It could be about, a senior executive in the company that's not working out. It could be about a new competitor that just jumped into a market. By the way, this just happened with me 3 nights ago, that, last week. And, that a new competitor jumped into the CEO's business. And, we had a late night session trying to figure out like how to respond, what to do about pricing and so forth. So, we give them a lot of guidance along the way. The money is the least of it. Yeah.
Very interesting. And going forward, do you get involved in the governance? Because startups generally tend to have weak governance.
Very true. Initially, the entire focus of the business is to build a good product and then find customers, right? That's the entire focus.
Right.
But we want to make sure when we get involved with the companies that, they have a corporate lawyer. It doesn't have to be a full-time employee, part-time person from a law firm. We want to make sure they have inexpensive auditors that kind of look at numbers. We want to make sure they use an outside accounting service because they can't afford to have typically inside accountants, and make sure they get into the habit of closing books every month.
Right.
Because, if you don't know where your financials are, so your cash, more importantly, your cash, right, then you can make all kinds of bad judgments, right? So getting that visibility and the discipline in place. We also try to bring on board independent board members, particularly diverse, board members, women, minorities, and so forth, into the board that have skill sets in those areas, so that they can be guiding them more directly in the market segments that the company is playing in, right? So that's another, help that we bring in. And then as the company evolves, and let's say it's going to go public, which has happened with a handful of my companies. We bring on board members that can be audit committee chairs. They're sort of experts in finances. We bring on people that can be compensation committee chairs. And so all the stuff that you need to build a well-rounded board to make sure that whatever we're trying to do, let's say it's an IPO, it's a successful offering, right? Yeah.
Very interesting. My next question is that, in a portfolio of investments, there will be some inevitable failures.
Yeah.
How do you handle failures and underperforming investments in your portfolio?
Yeah. So, by the way, you're totally right. For companies that take seed investment to Series A, which is typically where we play, what we see is that about a third of those companies are actually going to fail, either return no money or return less than your investment. Another third will just return maybe somewhere between 1x and 2x your investments. It is really the last third that, give you a 10x or sometimes, 20, 30x that yield a return for the overall fund. That's why I think having a diversified portfolio, across several years or different market circumstances, across different sectors, right, is really important. And across, different types of founders is even important, right? Including founders from different backgrounds. It's really important to get that diversity. So when the companies start to have troubles, it doesn't happen all of a sudden, right? Usually companies start to experience issues gradually. So the first thing we try to do is to try to understand, like, where is that problem coming from? If the technology is robust and the market's going to take some time to develop, we want to make sure they keep the burn low, perhaps give the company more money to keep going forward. If it looks like the market that they're addressing is adjacent to another market that is blossoming very quickly, then doing the product pivot towards the more interesting market is something we would typically advise them to do. And in many cases, when all else fails, right, we try to see if we can find buyers. Many times private equity buyers that are assembling, let's say, a set of technologies along with other businesses they've bought might find this of interest, right? They may not give you a lot of return on your money, but at least you find a home for the company and, very importantly, the employees, right? So we worry about that a lot, that employees have a continuity in employment. And even if you're not going to make any money in a company, we want to make sure it ends up in a place where there's continuity for the employees.
Very interesting. And Ajay, very often I have seen a strained relationship between the founder and the investor because aspirations differ. How do you navigate these challenges, if any?
Yeah, so as I mentioned, especially for early stage investors, these relationships are a decade or more long, sometimes more than an average US marriage, which is about 7 or 8 years, right? So these are like long-term relationships. So just like in a marriage, you have to have constant communications and goal alignment, starting from the very beginning. So when we are looking at these investors and assessing them, we want to make sure that they are going to build something that is aligned with our goals of how big we want this to be. How could this be, because we don't go into any company thinking it's going to be a failure or a 1x return. We go into every company thinking it's going to be a 30x return, right? So we want to make sure that that possibility exists, and part of that is answering that why now and why you questions that I talked about earlier, right? So I think as these companies evolve and develop, we want to make sure we give them guidance so they end up in a good place over time. Yeah.
Very interesting. And the other challenge that I have often seen is that the investor wants scaling up and the founder says, let me take my time. How do you answer this one?
Yeah, so that is an example of what you were talking about earlier, right? So, my personal view is that the investors cannot know the business better than the CEO or the founder. There's no way, right? I'm like on half a dozen boards, and I've got another half a dozen companies that I'm watching over in different capacities. There's no way I can have the time to, run around, really understand that specific business that I've invested in better than the team, and importantly, the founders and CEOs. So I think at the end of the day, we believe in letting the CEO make the decisions, okay? We give them guidance. We give them introductions to lots of different industry resources in the industries that they're working in, because we have those connections and contacts. We give them, in our case, we actually introduce them to coaches if they're having issues with their own management style, rather than trying to make a change of the CEO.
Right.
We try to introduce them to coaches. I mean, there's a very interesting company called 10X CEO that you may have heard of. We ask our CEOs to consider, joining that club, where you not only learn from a coach, but also from peers, peers that may be ahead of you in revenue and company evolution, right? So I think what you do, if you build a lot of trust with the founder, and they begin to believe that you are really looking after the interests and they're not watching their back, as sometimes happens with venture firms, then you reduce the possibility of conflicts. Not to say that it's completely eliminated. Human beings are human beings, and there's bad behavior on all sides, right? Sometimes venture capitalists behave badly, and sometimes founders behave badly, right? So you just have to be watchful for that. Sometimes that happens, but I think there are ways to avoid that if you're continually engaged with them and having a dialogue and dealing with problems in an upfront way.
Interesting. So time for a few more questions.
Sure.
What role does ESG and sustainability play when you are taking a decision to invest?
There are firms that are ESG investors. We are not. We handle our to make a profit on them. But in the way we make sure that we are sensitive to those issues is, number one, having diversity, not just in the management team, but also on the board. Actually, for companies that are now going public that are California-based, it's a requirement to have diversity on the board, which we are fully supportive of. For those of our companies that start to get to scale, let's say over 100 million or so, we ask them to start taking a percentage of their profits, and putting towards social causes. We feel very, very strongly about that. In the offices, obviously, these are decisions that the CEOs need to make, right? So, one of my companies which became profitable very early started, actually doing that very early in their evolution. So we are very delighted to see that. And it's actually helped their business because they talk about the types of causes that they're supporting. And then I think within the premises of the office itself, we try to make sure that they are, making sure it's energy efficient offices, that they don't have plastic floating around in plastic bottles and actually have coolers. We actually are an investor in a company called Bevy, which replaces, all this plastic waste in offices and gives you healthy flavored water. Company's called Bevy. So so we make investments in those categories. We try to support the entrepreneurs and founders and CEOs to think about these issues and take them seriously. At the end of the day, we are the supporting cast, right?
Yep.
The main performers in this act are the founders and the CEOs and the management team, right? So we want to give them advice and, from our years of, working in this issue and losing our hair, right? So all the experiences that we have with our own companies and working with lots of companies, over 400 companies in Trinity's history, we can give them that playbook and say, look, it's your decision, but here's what others did when they faced these circumstances or situations. Yeah.
Well said. Well said. So time for two more questions. My next question is to ask you about the ones that got away. Everyone has a lot of successful investments in
Uber.
Okay.
So yeah, Travis, who was the founder, was that's hurtful. He was on a board with me, a company called Crowdflower. So we were board members. And I was sitting, and he came to me. This was, I think, in 2009, and showed me this app on the phone. And at that time, it was called Uber Cab. And he basically said, "Look what I can do." And a limousine pulled up. So initially, as you may know, Uber's idea was to be a limousine service, basically serving the Silicon Valley, elites in a way. And I kind of said, what is this? This is like a very elitist product. How is it going to ever find, a big market? And then after that, they even came and presented to us at our office. They were using the seed round, by the way. I just didn't see it. They pivoted, obviously, after that interaction. They pivoted to becoming a P2P service and not just dealing with the limo services, which they started with initially. So that was, I still think about it. So
what a great response. Thank you. And my last question, Ajay, and this is for the thousands of people who will watch and listen to our conversation. Based on your amazing understanding of startups, and a very large number of our viewers are young startup or potential startup entrepreneurs, what would you say are 3 lessons you would want them to take away?
Well, firstly, because you mentioned that 62% of your audience is in India. I'm not just saying this because I grew up there. What's happening in India and what's going to happen in the next couple of decades, it's going to be transformational for the global economy. So, I remember once listening to Narayan Murthy, and he basically said that entrepreneurship is taking creativity and mental energy and converting that into wealth, right? And if you look at the history of India and look at the, millions and millions and millions of local businesses everywhere, right? Mom and pop, as we call them, corner stores and so forth. There's a long legacy of entrepreneurship. I mean, those people did not go for venture capitalists. Most of them, use their own money. They didn't go to even banks. But, that gene in the Indian, ecosystem has now got the education. And finally, in the last decade, has got the capital.
Correct.
I mean, $27 billion went into the Indian economy last year in the startup world, private equity and venture capital. So I think that capital can be transformative for a culture like that is, already driven to succeed and work hard. And then education is predominant. So my advice would be, for everybody that is working, for large companies or so forth, at some point in your career, look at making that jump. Right. That would be my, first advice. And then I think, seek the counsel, start attending, there are so many different events that happen in Bengaluru and New Delhi, and Chennai and everywhere. And obviously in San Francisco, for decades now, there's almost an event every 2 days. Go to those mixers, meet people, understand experiences, think about your own backgrounds. Where can you find an idea that might make you really excited about what you want to do, and make that plunge. Make that plunge at the right time in your career, because you don't have much to lose. I mean, in this economy, you're largely using somebody else's money. And if the idea is good and you raise the money, that means people have validated it. So go for it.
Yeah. Well said. And on that note, Ajay, and your amazing pieces of amazing lessons. You of course said that India will be a transformative economy and will transform the global economy. You also said capital will be available, but it's very interesting that you said a lot of the young people should consider making the jump sooner than later to entrepreneurship. And you
Right.
also spoke about training themselves and about networking and then taking the
That's right.
plunge. Thank you,
That's
Ajay,
right.
for speaking to me about your own amazing journey. Thank you for speaking to me about so many different aspects of your investments in the startups, in the early stage startups. Thank you also for taking me through so many different ways you evaluate founders. Thank you again for speaking to me, and good luck.
It's been my pleasure, Ashutosh. Thank you.
Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.